Welcome to Metechi podcast. Today we're going to discuss the effects of the coronavirus crisis on the commercial real estate area. We have with us one of the leading experts on the topic, Mr. Victor Calanog. And Victor, welcome, and I will leave it to you to introduce yourself.
Thank you so much, Zohar. I'm Victor Calanog. I have served as the chief economist at REIS since 2005. Upon the acquisition of REIS by Moody's Analytics last 2018, I was appointed as head of commercial real estate economics. And in this role, I lead a team of analysts and teams to really just take a look at the commercial real estate landscape, performance metrics, rents, vacancies, how are things going for specific property types and geographic markets. And we've tracked the sectors over 40 years since REIS has been around since 1980. We have never quite encountered a time like today, given the extent of this pandemic. So that's what I've been doing over the last 15 years. And I know it's a much abused word these days, but we are really in unprecedented times.
Yeah, well, staying in a lockdown for 67 days now, that's clearly unprecedented. And I wouldn't believe that I would keep sanity during these days, but we get used to it. Hopefully not for too long. So thank you so much for joining us. The coronavirus crisis has affected the commercial real estate area and the financial activity that supports it. Could you give us your outlook for the CRE market for, let's say, the next 12 months?
Sure. Each property type will likely perform differently given the relative position with which they entered this downturn. So if you wanted to start with the good news, I can focus on the multifamily sector, again, an income-generating asset class. Households pay rent. We were entering this downturn in a position of relative strength. We had vacancies at 4.7% as of the end of 2019 for the nation as a whole. By comparison, that's pretty low compared to the long-run average of about 5.2%. So you're looking at, 10 years of pretty solid strength in terms of solid rent growth, pretty high supply growth for some markets and neighborhoods in particular, but demand was obviously keeping up because vacancies were still pretty low and rents were growing, albeit not at the pace that we saw, likely at or around 2015 or 2016. So for the multifamily sector, we expect that vacancies will rise, no surprise, given the duration and severity of this downturn, but it won't rise by as much as the other property types. We're expecting multifamily vacancies to end the year at around 6.5%, which is a good 150 to 160 basis points below the historic high of 8.1% that this sector hit in 2009. So if you think about that, that's actually me being relatively positive, because if this recession will be anywhere from 1.5 to 2 times as bad as 08-09 in terms of GDP contraction, and that's what most baseline forecasts are expecting it to be. The fact that multifamily vacancies won't even hit historic highs relative to 09 means that it's probably going to survive this downturn, not unscathed, but relatively strong. Now, as we skate down the different property types, industrial will also probably survive relatively well compared to other property types like office and retail, given that the headwinds that are going to keep retail down. And, that's why we're a little bit pessimistic about retail. Things like a greater shift towards online purchases will likely benefit the industrial sector, particularly warehouse and distribution. I wanted this to be interactive as well, Zohar. So let me just ask you real quick, with this quarantine in place, how are your Netflix or streaming viewing habits coming along? Higher? How's the household coming along? What do you guys do in quarantine?
So we certainly watch more TV than the normal. I'm now in the middle of the series of The Last Dance with Michael Jordan.
Of course.
With our idol. We were big fans of Chicago Bulls during the 90s. So it was
It's a
nice.
great way. It's a great way to relive the 90s, right? So, if you think about the industrial property type that will likely benefit from this kind of distress, well, it will be data centers, right? So I'm not as worried about industrial property types that appear to be benefiting from this distress. I'm also not so optimistic as other people seem to be. They think that industrial properties will be absolutely fine. I don't think that's going to be true because as you see, J.C. Penney basically closing 242 of its stores. They just announced that today. That's 30% of their footprint. A large part of what drove demand for warehouse distribution are distribution centers for brick and mortar retailers, right? So, that substitution effect for online sales is not going to happen seamlessly. So it'll go through some distress, but compared to office and retail in particular, I don't think you'll see industrial in the news as much. What we are seeing in the news a whole lot will be a couple of sectors in commercial real estate. Number one, quite obviously hospitality, given how travel has really collapsed, both on the personal and business side. I believe that occupancies have ticked up slightly, but it's still in the 20s. So think about a 20% occupancy rate for a sector that averages maybe 60 to 70%, depending on the geographic area. And you're just looking at a lot of loans, for example, that can't even meet debt service coverage ratios of 1. So a lot of immediate distress for hotel. The other sector that's suffering a whole lot right now is retail. No surprise, it was under a lot of pressure before the onset of the virus. And then you got hit by this 1-2 punch of just an incredible pullback in demand, but at the same time, mandated store closures. So, you can keep your stores open and then try to wish for demand, but if you have to close your stores, business is done, right? And so I think that you see a whole lot more of hospitality and retail in the news in terms of immediate risk. I think what's interesting is if we talk about office space, which is kind of in the middle, you don't see it in the news as much, but I wonder over the medium to long run, now that a lot of employers have been compelled to allow their workers remote access, I wonder if a lot of companies out there are going to be reevaluating their need for office space in the future, even if this pandemic goes away. And, we've got CEOs of major companies like Morgan Stanley basically saying that. They're saying, look, we've proven that we can operate without an office footprint. We're going to go back to the office, but we're going to think seriously about what's next in terms of how much space we actually pay rent for. Twitter, I believe last week, has basically said, look, it's forever, right? You can work remotely forever if that's what you're comfortable with. I don't think Google and Facebook have gone that route yet, but they have announced that you don't need to return to the office till January of next year at the earliest. So just think about the intermediate to long run risk in terms of how demand for space in the built environment will evolve because of this COVID-19 shock. So that was my quick overview, not so quick, I suppose, of the different property types in commercial real estate.
So let's drill into specific questions about that. Thank you so much for this overview. And I want to speak about the office space and the multifamily together. One trend that we see with regard to office space is stay at home and keep working from home. That would reduce the demand for office space. But another trend we see goes the opposite direction, which is now social distancing will require companies to get much spacious place because you have to keep the 6 feet away from between the employees, and you have to have some buffer zones, and you have to have so many additional areas. So that would require more space in the office. So how do you see these two conflicting trends affecting the office?
I think that's an interesting point, Zohar, that there's always a push and pull, right? It can't be all negative. I do think that we can look back at 9/11, for example, when it was pretty easy to make predictions that downtown Manhattan is going to be permanently down, right? And people are not going to want to live there and work there. And surprise, actually quite the opposite happened. So we always want to take these predictions with a grain of salt, because it's probably not going to go to the other extreme as much as it'll be somewhere in the middle. And the way I'll answer your question is something like this. In the office sector, as it turns out, there was an interesting reversal of trends from suburban office space being the more favored, well-performing asset class in the late 80s, especially in the early 90s, to central business district. Nowadays, everyone thinks, oh, cities are so great, cities are so sexy, young people want to live there, and if you're, a new employer, you need an address in a central business district to attract the smartest, brightest young people coming right out of college. But that wasn't always the case. In the 1980s, the crime rate in New York and many US cities was really pretty high. Populations and households were moving out to the suburbs, and actually, 80% of all new office development from 1990 to 2010 happened in suburban areas. So if you think about it, back in the day, suburban office markets were in fact the investment du jour. In 1998, BOMA basically said the best investment you could make in office is suburban office space. But of course, it was right around that time that cities became sexy again. Crime rates began falling. People began moving back to the cities once again. This was exactly after around the mid-90s when that switch happened. And to this day, central business districts have really ruled the roost. I wonder if within metropolitan statistical areas, we might not see a net zero effect of the coronavirus as employers and big companies, for example, take a look at central business districts, shy away from dense urban areas, and then immediately relocate nearby to suburban office space, which, by the way, on average, is about 20 to 40% cheaper than downtown space, right? So I don't think a lot of companies will actually de-densify and move all the way across states, because there's a reason why you located your business in New York, right? You're not going to up and move to North Dakota just because office space is cheaper there. But if it's within 25 miles of your original CBD location and you find suburban office space that will give you that space to allow social distancing, give your employees the kind of confidence to return to work again, you might actually lease more space in the suburbs so that net on net, your metropolitan statistical area might not have a big change in occupancy levels, right? But you might see CBD vacancies rising and suburban vacancies dipping, whereas right now, it's actually the reverse, right? So I think we'll see more and more of that dynamic the longer this lockdown goes and the longer this sets and becomes more of a habit. Right now, I'm a little bit skeptical that you'll see big changes in the office sector. Leases are likely going to roll over the next year or two. I don't think a lot of companies want to make a lot of changes right now, but over the next year, 2-3 years or so, I don't think this is going to be the last pandemic that we're going to encounter, hopefully not too soon. But I suspect that a lot of companies are now thinking exactly that way, right? Do we leave dense urban areas for someplace cheaper, closer, but at the same time give us the kind of space that we need to reconfigure and communicate to our employees that we are thinking of their safety and we're changing alongside it. And I participate in those conversations with senior management, right? What does it mean to go back to the office in New York? Will you limit the number of people in elevators? What does that mean for a 52-floor skyscraper? Will you have meetings? Will you limit the number of people in meetings? And I think all of that will definitely impact the kind of decisions companies make soon once their leases start renewing.
So thank you very much for clarifying this trade-off. There is another trade-off that is at work here and might affect what we see. So if you can work from home, so many people will realize that they don't have, for example, to rent a house or an apartment in California, which is very expensive, and they can relocate to different states in that regard. And so one effect that you might have is about employees deciding to live in different states or different places where it's going to be cheaper for them to live. But another effect that you will see, so the work at home, as we have seen from being at home for 2 months now, is people would buy less clothes, less shoes, will use less dry cleaning, less shaving materials, will use less taxis and Uber and the like, will not use restaurants next to the office, will not go down and buy something on the way. So that would also have an effect on, again, on the retail around all the areas that now offices are the center of activity. So I'm not sure, and that's what the question for you, how these trends, how do you see them affecting on one hand, the multifamily markets and the housing markets, and then the retail, which is in the area next to the center of the offices as we know it today?
I mean, I think you're getting at a really, really interesting question here, Zohar. It's actually the fundamental basis of why cities exist in the first place, right? It's the benefits of co-location and agglomeration. Now, if this pandemic lasts longer than we think it will, and there is now a disincentive to co-locate, to your point, all of these establishments, whether it's retail, whether it's office properties. By the way, let's talk about entertainment and cultural establishments in the New York cities of this world, right? Think about Broadway, think about theaters and performing arts. These require a certain level of density of people. You need to pack people in theaters, right? What does that look like in a world where we are hesitant to go back and mingle and congregate? I suspect that we will revert to old habits fairly quickly. And as an example, you know, the virus is still out there, but New Jersey will reopen its beaches for Memorial Day. So this weekend, I wonder really how strictly will those social distancing policies be enforced in New Jersey beaches now that people can actually go out after being cooped inside for 2 months. So let's see. But to your point, the longer this goes, and the less confidence we have to congregate, then it will throw into question the very viability of how some businesses approach and run their operations, right? So in other words, look, retail has been under pressure from online commerce for at least 20 years. We know this. A lot more of us are, to your point, shopping online. I suspect this pandemic just kicked that trend into high gear, and I'm not sure we will go back through that door now that it's open, right? Some retailers, brick and mortar, have tried to adapt. What they've tried to do was to transform the retail experience into something more experiential. You're not just buying a product, Zohar. You are, I don't know, going to American Dream. I forget what, it's a 30-year delay now, but it just literally reopened here in New Jersey in Meadowlands, right? Huge mall, Nickelodeon-themed slides, because, you know, if you go there with your kids and your family, you can go through water slides and spend the entire day there and watch movies and buy retail goods. That's great. What happens now? What happens now when we don't have the confidence, once again, to go through these experiential things that retail, brick and mortar was banking on, right? What happens now to Broadway, to sporting events, to sports leagues? NASCAR just restarted 2 days ago, right? Cars were speeding through the racing circuit. There was no audience. So I think that over time, the short run risk is to try and deliver products and services and the experience, given this pandemic is still out there. But over the long run, I do think businesses need to rethink how they'll deliver their concept of value, right? If it's basketball games that we're looking at and your revenues are driven by ticket sales, what does that mean in the future when ticket sales might not be? How will you compensate the Michael Jordans of this world, right? Because, you know, they're supposed to be the draw. They're supposed to be the ones that are filling up the stadiums. Is that all going to happen on pay-per-view now? Is that going to benefit HBO and Netflix, but not the stadium operator? So I do think that the longer this goes, I don't think I'm going to go to the extreme and say it will change everything permanently. That's not probably going to be the case. We are creatures of habit. But 9/11 did change the way we travel by air permanently, right? So there will be some changes. And a lot of it is up in the air, given that I suspect this is not going to be the last pandemic we'll encounter.
Let me touch a bit more on the hospitality. So after 2008, it took the hospitality hotels and the like to recover about 4 years. Do you see the same trend taking place now?
I suspect that a lot of it will depend on whether or not, number one, there is a credible treatment and vaccination option that is offered and made widely available, right? And number two, you will probably see recovery happening in stages, right? The number one, we will likely have depressed fundamentals and performance metrics as long as people are not confident about going out and traveling, period, right? Why would you need a hotel for business or travel when we can meet via Zoom for business, right? Or, you know, if you don't even want to travel, if it's literally prohibited. The number two, in the short run, I suspect that when we do leave our houses, when we do reopen the economy, one of the hospitality sectors that will recover first would be locations that are drive-tos. So in other words, I might not be confident hopping on a plane right now, but maybe I'll plan a trip with my family to places where I can drive. So think about that just geographically speaking. I think West Palm Beach will recover faster, right, than Las Vegas or Hawaii, certainly Hawaii, because Hawaii is definitely fly to. At least Vegas, you have folks from California that can drive through 5 hours of desert to get there. But if you're not a drive-to destination, if your business model requires a different sort of travel that's now perceived as a little bit more risky, just expect that recovery to be a little bit more extended than you think it might be, even if the economy is reopened.
And this crisis also created sort of a pause on transactions. How do you see the future of transactions?
Well, if you just take a look at disruptions over the last 10, 15, 20 years, on a quarter-over-quarter basis, it tends to be pretty sharp, and then we're always in a search for the right comp, right? So if we're doing deals right now, what is the correct value that I should be assigning to any kind of property, any kind of financial asset, if I was the buyer or if I was the seller? And I think the uncertainty out there is hitting the pause button on these transactions precisely because it's hard to determine value. So our data suggests that there was a 47% drop in transaction volume in commercial real estate in the first quarter. And that's the first quarter. I mean, you know, the pandemic kicked into high gear, escalated significantly in mid-March, right? So I expect that the second quarter will be even more severe. Some deals are being made, and what we are seeing, at least in the near term, is that none of them are distressed just yet, right? So in other words, for those vultures who are supposedly circling around the carry-on right now, big article in the newspaper this morning about how distressed debt funds are raising money right now, something to the tune of $400 billion worldwide, expecting that there's some kind of fire sale that will happen soon. The fire sales aren't happening yet, partly because transaction activity is still pretty frozen. So that's the caveat I wanted to give. And when you're searching for the right comp, it's particularly hard right now because transactions really aren't happening. What's the value basis for the transaction? Over the long run, though, I do think that once things restart and we have a sense of how we should reprice assets, it should follow that the performance metrics that drive income fundamentals, if the market is at all rational, and sometimes it isn't, should determine which property types will suffer more as opposed to less. I'll give you my projections of what will happen in 2020. I'm actually hoping I'm not correct because there's a whole lot of distress here. Let's see what happens. I expect multifamily property prices to fall by the least by around 7 to 8%, followed by industrial properties at around 9 to 10%, followed by office properties between 12 to 14%, and then followed by retail properties at a 20% discount relative to what it was in end of 2019. What am I basing this on? Well, we're going to get all wizardy here, right? You know, econometric projections based on how severe things will get for GDP and how specific markets perform. And it's all crystal ball gazing, Zohar. We don't have comps, right? I expect that when the market thaws, we will see exactly where pricing goes. And the only basis that I think I'd like to anchor my projections on for pricing would really be on the income fundamentals. So if I expect retail and hotels to do really poorly on the income side, then values should drop accordingly. So let's see. I've said this on some webinars, so I'm hoping I am wrong. in my most pessimistic of projections. I'm hoping that we shouldn't discount the possibility that when we reopen the economy, there will be no massive reinfections, which will require us to close again, and that there might be a ton of revenge purchasing, right? And all the support we're getting from the fiscal side and the monetary side will bridge us through. And then next year, I don't know, we'll just remember this as the strange spring when we had to stay home. I suspect, though, that that's probably a little too optimistic. So we'll see.
So another aspect of transactions is in fact construction. Well, what would you see? What's your prediction that we will see being built in the next 12 months?
News just came out today on the home building front that home building permits declined by the largest amount since the government basically started keeping records in 1959. Right? That's not commercial, that's not multifamily. I understand that's single family home building, but just think about the fact that last February 19, when home building permits came out, it was actually the highest figure since 2007. So, this was the home building permits on the construction side was actually really on the way up, and now it's a record decline. I think two things complicate the picture here. Number one, depending on the place, you're going to want to be really, really careful about making sure that you know the policies in place. In other words, in Boston, construction has been deemed as non-essential, right? So expect more delays on that front when it comes to construction. In Texas, surprise, construction is essential. And so even though Austin actually in early April said, we're going to halt construction, as it turns out, when the governor said, no, it's essential, Austin had to backpedal and say, okay, I guess we need to allow construction. So expect less delays in the Texases of this world and maybe more delays on the Northeast, certainly New York State, right? Not for all property types. If it's affordable housing, if it's infrastructure, if it's home repair, that's still going on. That's the policy side. That's the one factor we should consider in terms of construction delays. The second factor we really need to consider too is, well, okay, this coronavirus is not just a local shock, is it? It's a global shock, which means now your supply chains are disrupted. You might want to build stuff in Austin, but I'm not sure a lot of people realize this. A lot of our supply of window shades, for example, come from Italy, right? And if Italy isn't back online yet, they aren't allowing tourists back till June, then think about how that disrupts your supply chains and your expectations and causes construction delays.
So let's move a bit to the financing side. Given your experience, how would the banks would react to the challenges that their borrowers are facing?
I think banks and lenders are rational, right? And so as with any kind of downturn, they are now ramping up standards for whether or not they will approve loans or refinance loans. I think they still need to do business. Obviously, they want to keep their borrower relationships, but I think you should forget about those. We never really did get into the heady days when banks were approving 90% LTV loans, right? But now it's back down to 55 to 60. So when I have big lenders that are taking a look at whether they should refi some loans, we have some banks at the household side that are at least allowing some form of relief, but also read the fine print, right? So you might have a mortgage from one of these big banks. They say you don't have to pay it for the next 90 days. But in your fourth month, as it turns out, you're on the hook for all 4 months of payment. So read the fine print. I'd say that, sure, on the financing side, there's still some activity going on. I think some banks are better positioned than others to make sure that they strengthen their relationships during this difficult time. But no surprise, it's like on the transaction side, a lot of transactions aren't happening because banks are also uncertain about what the right value and income metrics are. We're all kind of rethinking what's next, right? So if I was a bank and if I had to approve financing, I'm thinking, okay, well, what is this a retail property? Is this a hospitality property? What's its prospect? Zohar just said we don't expect it to recover fully for 4 years. How exactly do you underwrite that? Think about new construction loans, right, for financing arms. We had a lot of student housing properties supposedly coming online by this summer. about 70% of all new construction in student housing is happening for properties that rent by the bed. We were expecting a 4.5% increase in inventory fall 2019 to fall 2020. The economics of construction and student housing is interesting because you want to make sure that new properties online by July or August, right? Because then the students come in, it's fully leased, you convert it into a permanent loan, and then you're all set for the rest of the academic year. What's going to happen to student housing new construction now, given that a lot of schools haven't exactly decided whether they'll allow their students to return in the fall? Actually, that's not true. Cal State decided last week that they're not going to hold classes through 2021. That's the largest university system in California that has 500,000 students enrolled in it, right? So think about the disruptions that will cause on the financing front as all these new student housing properties were supposed to come online and now they're not. So I think it's just a general uncertainty that's making a lot of financing sources, banks, lenders alike, hitting the pause button as well.
So in this regard, what we see that sort of signal what's going to happen in the banks. So we see that the CMBS market, which is a public market and very transparent, we see that the number of non-performing loans is rising. We also see some of the REIT companies that are financing using debt or repo or short-term debt also get into liquidity crunch. And these two players are expected to be in the market selling those non-performing loans. The banks normally are coming in a delay. Sometimes it's 6 months, sometimes it's longer because they are trying to do some workouts and work with the client. At least the experience of 2008 has shown us that the longer the bank wait, the deeper the discount that they will eventually sell the loan. So I assume that the CEO of a bank who is a veteran of 2008 already has that experience and would understand they need to clear the balance sheet by Q4 and start.
Otherwise, they can't lend. They're paralyzed.
And start a clean slate in 2021. But what is your estimate about the role of the funds who are buying the non-performing loans and the distressed debt on the market? As you mentioned, it was just a story about the amount of hundreds of billions that they are raising in order to enter this market. So what's your estimate about their role in this market?
I think we'll be able to tell just how active distressed debt and buyouts and workouts will be once we have a little bit more traction and activity on the transaction side, because I think that there's still a lot of relatively wishful thinking out there that this is a quote unquote artificially caused downturn and freeze up in the market. In other words, it's not like the economy imploded. There was a virus, it's a public health scare, and we shut the economy down. So my suspicion is when we start to reopen the economy and there's some transaction activity that happens, banks, even for CMBS, right, we are seeing loans in the watch list increasing, but because of forbearance, it's not like we're seeing a lot of these loans being sold at the big haircut just yet. So there's that bridge period where I think everyone's on pause, waiting to see once we restart the economy again, right? Will it be a relatively quick recovery? In which case, I'm not going to give that much of a haircut, right? Things are recovering, right? Or will it be, surprise, we restarted the economy, businesses have closed permanently. The worst predictions that we had for retail and hotels have come true. We're not going to recover till early next year at the earliest, right? And now I need to move this stuff off my balance sheet really quickly. And I suspect it's somewhat going to be binary that way, Zohar. I think once we reopen the economy and we have a sense of where pricing and value is, we will either see not that much of a haircut going on because it's artificial to begin with. That's great. We can, we were pretty okay before this. If you take a look at the delinquency rates for even, dust lenders and so on and so on. It was close to zero. It's hard to build credit default models if your delinquencies are zero, right? Even we'll go back to what it used to be, or it will likely be the other binary side where, you know what, this is going to be a little bit more permanent than we thought, and we need to clear the balance sheet really quickly, and then there will be discounts. And I think that's when the distressed debt funds will pounce. However, it's also equally likely that they might not see as many discounts as they thought that they would, right? There was in 08 and 09, one data provider that literally created a service that said, you know what? Here's our estimate of which assets in commercial real estate are going to be distressed, right? What exactly are you going to do with that if you're a distressed? Are you going to call the Rockefeller Center and say, here's a data provider that says you guys are going to be in distress. I don't know what's going on in your balance sheet, but would you sell it to me for 50 cents on the dollar? I'm not sure that actually distressed asset sales work like that, right? So it's a lot of wait and see, and I suspect it will be one or the other, Zohar. It's a lot of wait and see right now.
So we can talk about that for hours. Believe it
yes,
or not,
exactly.
But our time is over. It has been wonderful to hear your insightful analysis, and I'm sure our audience will enjoy all the points that you have explained very clearly. Thank you so much for joining us on this podcast.
You're welcome, sir. Thank you so much for having me.